Compounding is the ultimate wealth builder, the quiet force that turns small, consistent efforts into massive results over time. But here's the deal. Most people only think of compounding in terms of money. While that's a huge part of it, compounding applies to so many areas of life. If you learn to harness its power, it can transform your finances, skills, relationships, and overall success. So let's break down 12 compounding strategies you must know that will help you double your money. These are practical, actionable steps that can set you on the path to exponential growth. 1. Start investing early. The earlier you start, the more time compounding has to work its magic. Time is the single most important factor in compounding because it's what allows your money to grow exponentially. Let's say you invest $5,000 annually starting at age 25 with an average return of 8% per year. By the time you're 65, you'd have over $1.3 million. Now, if you wait until age 35 to start, even with the same annual investment and return, you'd end up with only around $600,000. That's nearly half the amount, just because you delayed by 10 years. Starting early doesn't mean you need to start big. Even small, consistent contributions add up over time because the key is to take advantage of your greatest ally, time. 2. Reinvest your earnings. Whether it's dividends, interest, or capital gains, reinvesting your earnings is like giving your money a growth hormone. Instead of taking out the returns, let them stay invested. For example, if you're investing in dividend-paying stocks, dividends are your friend, as companies will pay you a portion of their profits for just holding the company's stock as you are an investor. So, if you own dividend-paying stocks, opt for a dividend reinvestment plan, DRIP. This means your dividends automatically buy more shares, which then generate even more dividends. Over time, this creates a snowball effect where your wealth grows faster and faster. Also, reinvestment applies to more than just stocks. Think about real estate. If you're reinvesting rental income into buying additional properties, you're amplifying your wealth-building potential. 3. Focus on skill compounding. Learning isn't just about adding knowledge. It's about multiplying opportunities. When you build a new skill, it doesn't just stand alone. It often complements what you already know, making you more effective in everything you do. For example, if you're a graphic designer and you learn coding, you've just doubled your career opportunities. Or if you're an entrepreneur and you develop public speaking skills, you've amplified your ability to pitch ideas and lead teams. The combination of skills creates a unique value proposition that's hard to compete with. Invest time and resources into learning, whether it's through books, online courses, or mentorship. The earlier you start compounding your skills, the more exponential your growth will be. 4. Focus on high-yield opportunities. Not all opportunities are created equal. Some investments, whether of time, money, or energy, offer higher returns than others. For example, a well-diversified stock portfolio might grow faster than a low-interest savings account. Similarly, learning a high-demand skill like coding or public speaking can pay off far more than a less versatile skill. The trick is to identify areas where your effort or resources will yield the highest returns. Spend your time and money where they'll multiply, not just add, to your growth. 5. Leverage compound habits. Small habits might seem insignificant at the moment, but over time, their effects can be monumental. This is the essence of habit compounding, consistent incremental actions that stack up to create massive results. For instance, saving $10 a day might not feel impactful right now, but over 30 years at a 7% annual return, it adds up to nearly $370,000. Similarly, exercising for 20 minutes 3 times a week won't transform your body overnight, but over months and years, it can lead to significant health improvements. The key is consistency. Whether it's saving, learning, or improving your health, small, steady efforts lead to big outcomes over time. 6. Increase your contributions. Over time, if you want to double your money faster, you need to increase your contributions over time. When you get a raise or have more money to invest, don't just let it sit in your checking account. Put it to work. Increasing the amount you invest ensures that you're adding more fuel to the compounding fire. The earlier you start increasing your contributions, the faster your investments will grow. It's all about taking control of your income and making your money work harder for you. 7. Build and nurture relationships. Relationships have a compounding effect. When you invest time and energy into building connections, those relationships often open doors to new opportunities, collaborations, and networks. For example, helping someone today might lead to a referral, partnership, or mentorship years down the line. The trust and goodwill you build grow over time, often in ways you can't foresee. Focus on providing value and being consistent. Over time, your network becomes a powerful resource that can accelerate your personal and professional growth. 8. Take advantage of tax advantage accounts. Taxes can eat into your investment returns, but tax advantage accounts like 401k, IRAs, and HSAs help you keep more of your money working for you. By deferring taxes or growing your investments tax-free, these accounts supercharge the power of compounding. For example, if you invest $6,000 annually in a Roth IRA for 30 years with a 7% return, you'll end up with nearly $600,000. And here's the best part: all that money is tax-free when you withdraw it in retirement. That's the power of combining compounding with tax efficiency. Make it a priority to max out your contributions to these accounts. They're one of the easiest ways to boost your long-term returns. 9. Diversify strategically. Compounding works best when you're not constantly losing money. Diversification helps protect your investments from significant losses, ensuring that your wealth continues to grow steadily over time. Think of it this way: if one investment underperforms, others in your portfolio can offset the loss. This minimizes risk and keeps your compounding engine running smoothly. Diversification doesn't mean spreading yourself thin. It means being strategic, investing across asset classes like stocks, bonds, real estate, and even digital assets. The goal is to balance growth potential with stability. 10. Automate your investments. Automation takes the guesswork out of investing and ensures you stay consistent, which is critical for compounding to work. By setting up automatic contributions to your investment accounts, you're removing the temptation to skip or delay investing. This strategy is especially powerful with dollar-cost averaging. When you invest a fixed amount regularly, you're buying more shares when prices are low and fewer when they're high. Over time, this approach helps smooth out market volatility and maximizes your long-term returns. Set it and forget it. Automation ensures you stay on track and allows compounding to do its thing. 11. Track and optimize your progress. What gets measured gets managed. Tracking your progress allows you to see the power of compounding in action and make adjustments as needed. For example, regularly reviewing your investments helps you ensure they're aligned with your goals. If one area of your portfolio isn't performing, you can rebalance to maintain growth. Similarly, tracking your savings rate and expenses helps you find ways to save more and invest more, accelerating the compounding process. Use tools, apps, or even a simple spreadsheet to monitor your financial progress. The insights you gain will help you make smarter decisions and stay motivated. 12. Adopt a long-term mindset. Compounding is a marathon, not a sprint. It rewards patience and discipline, but it can be frustrating in the early stages when growth feels slow. The key is to stay focused on the long-term rewards. For example, In the first few years of investing, your returns might feel insignificant. But as the years go by, the growth becomes exponential. This is where most people give up, right before the compounding effect takes off. Adopting a long-term mindset means resisting the urge to chase short-term gains or time the market. Instead, stay consistent, stay invested, and trust the process. Over time, the results will speak for themselves. For a bonus, be patient and let time do its thing. At the end of the day, patience is the most important ingredient in compounding. You can use all the strategies in the world, but if you don't let time pass, your money won't have the opportunity to compound effectively. If you're in this for the long haul, stay consistent, reinvest your profits, and allow compounding to work its magic. The longer you wait, the bigger your wealth will grow.